Hi, good morning. You're watching The Market right here in 18 hour with me, Harsha and Nikunj, Dalmia in the studios, and managed to close in firm, at least in yesterday's trading session. Even though you had a quiet start, we managed to wipe out those early losses. So we're firm at that 18,300 mark, and it seemed like that FII sell figure day before was just a little bit of a blip because they're back in the market. In fact, yesterday both FIIs as well as DIIs were buyers, and yesterday it was IT Nikunj, and you got to doff your hat to the recovery in the Adani names.
So far so good.
Yeah.
I mean, one day of blip, that just does not change the overall sequencing of the big picture in terms of where the market in the near term they are headed. Let's look at the trader screen here, because if you are really analyzing the near term market view, let's look at the pull and the push pressure. With each passing day, the sellers are not there. So while global cues are mixed, FI flows are positive, FNO position is indicating that fresh long positions are getting added. FI, the streak of buying continues with one blip. And in terms of the general positioning post earnings, I guess the general positioning even for global markets is smooth. So nothing changes, at least in my book, in the overall scheme of things. Dips are being bought into. Sectoral rotation, I think, is evident. The treasure hunting in the mid and the small cap, it continues. I guess the only chink in the armor is the dollar index, which is going marginally higher, 103, 103.5. That in a sense could act as a trigger point for some mild profit booking, but frankly, I will not read too much into it. Now, the tricky part is, will the leadership in the market change or will it sustain? Because banks in last 2-3 days, they've done nothing. Mid and small cap stocks are making a comeback. Adani Group of stocks you mentioned, IT. So I think you could be seeing, so Nifty may now be pushed higher by different group of stocks.
Yeah, that seems to be the case. And don't know if Adani Groups can do that. At least they've got the sentiment or the cheer back in the market. What a solid recovery.
What a solid recovery. And it's like, it's like a wheel which has taken a full circle. From what the position
Feb to now.
Exactly. The wheel has taken a full circle. The concerns for the Adani Group of companies which were raised in the month of Feb, they were centered around high debt, inter-party transfer, pledged shares by promoters. All those concerns one by one have got addressed. The concern that they will default on their debt obligations, that's been nullified. B, inter-party transaction, that is something which has been addressed. Promoter have sold 1.8 billion of their personal equity to a foreign fund, and the balance sheets are light, and Supreme Court has given them a clean check. So what we've seen is first a big sell-off, then a recovery, and the markets would adjust. The difference, Aisha, is that it's not going to be same path for Adani Group of stocks in terms of appreciation, because what we saw last year was an extraordinary move.
Frenzy, yeah.
That frenzy is not going to continue. Also, the pace of business growth has to come down, because please realize that Adani Group of companies now will have to hunker their growth down because they've not managed to raise capital. See, for them in the month of Feb to March, it was about survival, ensuring the cash flows don't go down, ensuring that they don't default on the debt obligations. But the kind of expansion spree they were in, acquiring assets, building more assets, acquiring local and global assets, they'll have to go easy on that. And that means that in the near term, the terminal value of the stocks actually will come down. I doubt that in the near term, a lot of retail investors will come back till the time these stocks will not stabilize, but that's okay. These are stocks which in a sense do not, what are Adani Group of companies? They're in airport, they are in port,
infrastructure,
they are infrastructure.
largely, yeah.
These are long gestation projects.
Yeah.
So if you can really think outside 6 months, 1 year, 2 years, then these are good stocks because they represent the future India. But in the near term, I guess they will settle at the current juncture plus minus 5%. That's my sense.
Yeah. But having said that, the recovery, of course, has been phenomenal. In fact, the market cap recovery in the last 2 days itself has been just phenomenal. Adani Enterprises has managed an addition of 46 crore rupees. Adani Ports has seen, or rather 46,000 crore rupees, I beg your pardon. Adani Ports has seen a 15,000 rupee recovery, crore rupee recovery. In fact, the kind of recovery that they've seen from those budget time lows earlier this year in February. Adani Enterprises has shot up 127%. Adani Green has scaled up 115%. Adani Power has scaled up 87%. 85% recovery for ports. For Wilmar, it's 35%. Ambuja Cement, 34%. ACC, Adani Total, even NDTV, they've all seen a massive recovery coming in. But yes, whether the market is going to have a new horse or not, and the big question is, given the recovery that we've seen in the Nifty IT for the last 4 weeks and the price action yesterday, Nikunj, one is wondering whether it's going to be IT which is going to lead the way forward from here.
Looks difficult, Harsha, and I'll tell you why. Because large part of the price action in IT is also coinciding with what's happened to Nasdaq. Nasdaq is at a 52-week high, and we like it, we don't like it. The psychological correlation is always that Nasdaq goes higher, Indian IT companies will always go higher. But that really, there is no one-on-one correlation, because Nasdaq has different set of companies, Indian IT is a different set of companies. The concerns in the IT sector, I don't think they've got addressed, and valuations have not become attractive. So typically, either valuations have to become attractive or concerns have to get addressed. And I think right now we are not there yet. IT is not cheap. And you know the cycle is not going to recover in the next 2 or 3 quarters. So for me, IT is just a deep swell, nothing more, nothing else. I would still maintain and insist and stick my neck out that for me, banks are the leadership stocks. For me, there are a lot of side sectors which in a sense are showing you signs of inertia and signs of energy. That's how you want to be. You know, for example, what happened to railway stocks 3 months ago, what happened to defense stocks last year. The same is happening to electronic stocks now. The same factor is at play in a lot of niche manufacturing companies. Now, whether it is Keynes or Sharma SGX or Dixon or Amber, that space is again just vibrant with a lot of action and excitement. So you got to if you're a mid-cap stock picker, you got to focus on these niches in the market rather than taking a bet on the IT sector per se and hoping for the recovery. IT stocks are not cheap. The concerns are not over. These stocks, I think, could see some more time-wise and even more price-wise correction. Till the time you don't see red becoming yellow for the IT sector, I don't think IT is a buy.
Okay, that's the take on IT. Having said that, the recovery, of course, has been phenomenal, and more so for some of the mid-cap IT names. Look at a Persistent, for instance, that's jumped up nearly 30% on a year-to-date basis. LTI Mindtree has shot up about 14%. Coforge is up 13%. But yes, the one that set the cat amongst the pigeon, Infosys, still hasn't seen a meaningful recovery. In fact, it's down 14% on a year-to-date basis. So still a long way to go for this one, at least, for sure. But talking about setting the cat amongst the pigeons, there was also coming in a lot of comments coming in overnight, and Fed's St. Louis President James Bullard also saying that he's thinking 2 more rate hikes this year. What's the global commentary then overnight? Anisha is here with that compiled analysis. Anisha?
Hi, well, yes, what said the cat amongst the pigeon was the hawkish commentary coming in by a couple of Fed members. Of course, Bullard, as you talked about, said that he's thinking about 2 more rate hikes this year. So that entire thesis that perhaps the rate has peaked and there's a pause in place is out of the window. Similar commentary coming in from Kashkari as well, where he said that if we were to skip in June, that does not mean that we are done with the tightening cycle. It means that we are waiting for more information. So for now, none of the Fed members are willing to call it a pause at this point of time. Shifting focus to the most talked about topic, and that's the US debt ceiling, wherein Yellen again wrote a letter to the lawmakers, and she said that I'm writing to note that we estimate that it is highly likely that Treasury will no longer be able to satisfy all of government's obligation if Congress has not acted to raise or suspend the debt limit by early June and potentially as early as June 1. So constant pressure coming in as far as the Treasury is concerned on the government at this point of time, and the government is trying its bit. The U.S. Representatives Speaker McCarthy as well as U.S. President Joe Biden met yesterday. They are calling it a productive discussion. No agreement on the table yet, but both seem to be on board that default is out of picture at this point of time, and saying that the discussion was productive, and going forward they are expecting that an agreement will happen soon, but not just yet.
Right, okay, Anisha, we'll leave it at that. In fact, the SGX Nifty once again is indicating a quiet start, marginally in the positive, however. But here's Sunil Singhania telling us what he's making of the IT sector and whether this is going to be the sector which is going to lead the market movement from here onwards.
Indian IT services is one sector which is globally competitive. we discussed, that every company needs to have a digital strategy, and there is going to be huge opportunity for Indian IT services companies there. Yes, in the near term, we don't know. It is possible that 1 or 2 quarters the growth rates might be not as good as they used to be earlier. But these are companies which make decent money. As I said, they are globally competitive, and they have almost 100% cash conversion of profit, and they distribute almost 80-90% of that. In fact, if you actually see year to date, there are so many IT services companies which have gone up like 30-40% on the mid cap side. And even in large caps, there are quite a few IT services companies which have done much better than the Nifty. So despite all these concerns and slowdown and so on and so forth, I think the sector has done relatively well year to date. Yes, on a 1 year basis, it has underperformed because the previous 1 year it had done very, very well. But, the prices are not indicating, I would say, a horror show. In fact, they are indicating that if things settle down, there might be an upside surprise here. So we are not extraordinarily overweight, but we are not underweight also.
All right, let's talk technicals. Nooresh and Kunal, they're both already. Nooresh, banks are taking it easy, IT is making a comeback, but market, it continues to climb that, not wall of worry, but it continues to climb the wall of liquidity in this case.
So the moves have been interesting. The banks, if you look at ICICI Bank, it's just maybe 2 to 3% away from an all-time high. Even after not doing much, HDFC Bank is not far away from the previous all-time highs. It's not 10% away. Interesting cases, if you look at Axis Bank, which is coming up with new leadership, the stock has started trending up. IndusInd Bank has started trending up. So we are getting new leadership in the banking space. SBI, once it sustains 600, that would be an indication of leadership. But as of now, we have 3 stocks which are taking the lead. And another stock which would be in the, reckoning would be Kotak Bank, which has again resisted around 1950, 2000. But unlike taking a sharp drop, continues to sustain above 1900 levels. So the banks are continuing to look good. IT as a sector can see a bounce. There's a lot of sentimental pull-up from the fact that Nasdaq 100 is up almost 33% from the bottom, and it's just down 15-16% from the top. You're seeing USD INR trending up, and overall a lot of these stocks went through very sharpish correction. So in a consolidation phase also, there has to be some bounce from the lows. So in the large cap space, we are seeing some bit of a recovery, and this could continue. But the mid cap, small cap IT names have done really well. Many of the names are at 52-week highs, all-time highs. So we are seeing selective moves across the IT pack as well. So overall, the sentiments continue to improve, and IT doing up a little up move gives a better positive stance to Nifty as well.
Kunal, hi, morning. What is it that you're making of the trading sentiment right now? Quiet start, picked up once again in the green. FIIs were buyer again. So were DIIs actually. And it's IT which is leading.
Yeah, Harsha, good morning. And I think add to that, since it's the expiry week for the monthly series, we also have to start to look at the rollovers data. So, what happened yesterday was there was an incremental amount of, carry forward for longs for the indices for both the Nifty and Bank Nifty, and that is by a huge margin. Just to give an example, for the current month futures, there was an unwinding of say 520, 525 contracts on the Bank Nifty. But the built up, in the next month futures for the Bank Nifty was almost 4,000 to 4,200 odd contracts for the Bank Nifty. So that gap of 3,700 odd tells you that there has been an incremental amount of long built up which has happened into the banking index, and same is the case with the Nifty as well, which also has seen a good jump in terms of the relative change in the open interest to the next series. So that's also an encouraging data point. And if we see that pattern say for the next 2 days, then we could be looking at a start of a very strong series towards the month of June. Also, the month of June is an extended expiry because I think the expiry is on 29th of June. So we'll have a full 1 month, 4-5 days for the June series. So I think in that regards, the markets are going with a very strong bullish expectations, at least looking at the start of this week. And add to that, yesterday what we saw, that sector churns coming back, the Nifty IT index coming back into the flavor. And I think that aspect, you will see probably some sort of profit booking or a mild reaction to the other sectors. But eventually when all of these sectors, they tend to make a very strong coherent comeback, you see a next round of up move coming into the indices. So maybe a couple of days of consolidation further for the Nifty, but we would be looking towards a breakout on the upside.
Okay, and how does one take advantage of that breakout? What stocks can one bet on? Kunal?
So I'll suggest a couple of buy calls, and the logic sticks with the few large cap names. JSW Steel is one stock which I think has made a good comeback, formed a bullish hammer pattern 2 days back. Yesterday the stock recovered back above 700 levels, so would be looking to recommend a buy on JSW Steel, targets of 740, stop loss at 688. And HCL Tech has also been one of the recommendations in the last 2-3 days. That stock has also made a very strong and a durable comeback, trading about 1100 levels. Would suggest a buy 1150 as an immediate target. Stop loss is trailed higher to 1090.
Right. Nourish, what about your stock strategies?
So a repeat here, first is a buy on HCL Tech. The stock is making interesting formation for the fact that has recovered well. It made a bottom in August, September, recovered really well, went up to almost 1150 levels. Then did not see a sharpish correction like the rest of the large cap names. And now the stock is setting up for a move above that 1150 mark. If that happens, that would be a 52-week high also. So it's just, say, a little bit away from those levels. And technically is shaping up as a cup and handle formation. If it sustains above those levels, we could actually be in the reckoning for previous highs also. So this could be the leadership stock in the IT pack. So for now, going with the target price of 1250 and a stop loss at 1080. Second is the buy on L&T, which is more a defensive bet here. The stock has corrected back to that 2200 mark, which is the support. From here, I would expect a slow and steady pullback towards the 2400 mark. A stop loss to be placed at 2180.
Right, okay, and as we slip into a break in a major career milestone and a proud moment for India, Neeraj Chopra claimed the #1 ranking in men's javelin for the first time. The Tokyo Olympic gold medalist topped the charts with 1,055 points, 22 ahead of Grenada's Anderson Peters. The market right here in ET now, and a solid recovery coming in yesterday, considering it seemed like it's going to be one of those quiet consolidation kind of days. We made it back to that 18,300 print. FIs as well, after a day's blip, seem to be back in the market. They were buyers yesterday, as were DIIs. But a lot of stocks which are going to be in focus this morning, and it seems like it was a turnaround quarter for PB Fintech, the way they've actually narrowed down their losses. Let me take it across to Harsh and find out what's the analysis for Q4. Harsh?
Well, absolutely narrowed down and how. We're looking at revenue growth of 40% plus on a sequential basis. Very solid growth on the top line front, 61% year on year. The revenues come in at 869 crore. We're looking at EBITDA also. The loss actually turning to profit, 28 crore loss in Q3 turning to a profit of 28 crore in Q4. And mind you, last year the loss was at 80 crore, so significant uptick there. We're looking at margins therefore which have gone to a positive 3% from a negative 5% and a negative 15% same time last year. And we're looking at a PAT loss of just 9 crore versus a loss of 87 crore in Q3 and a loss of 220 crore in Q4 of FY22. So a significant improvement clearly visible. With regard to what's aiding this, the existing business, solid growth numbers, 18% growth with regard to insurance premium collected on a sequential basis, credit disbursals up 11% on a sequential basis. We're seeing therefore revenue up 20% on a sequential basis. We're seeing adjusted EBITDA up 146%, more than doubling there. And we're looking at core adjusted EBITDA margins of 13% versus 6% same time last quarter, just one quarter. With regard to new initiatives, also margins have declined from a negative 12% to a negative 1%. So clear improvement there, and very soon to turn EBITDA positive. We're looking at a top line of around 869 crore versus a total top line for the year of 1710 crore, which also grew significantly, 43% year on year. So you can see the kind of difference with regard to the Q4 numbers. Very solid set there from PB Fintech.
Okay, that's going to be a stock to look out for. Let's shift focus to Vedanta. That's, by the way, declared the first dividend for the new fiscal at 18.5 rupees per share. Let me take it across to Sharad and understand what really does this mean for the company in terms of an outgo, and of course what it means for the shareholders too. Sharad?
Well, yes, in focus we are having Vedanta, and they have declared their first dividend for FY24. And do remember the amount is coming in at 18.5 rupees per share. Now this translates to almost 6,900 crores of flows coming in from the dividend portion. And the interesting part is the dividend yield, that itself is up more than 6%. And for the shareholders, the record date is set at May 30th. Now, looking at the dividend history of Vedanta, we see, of course, in FY20 and FY21, the numbers were not very much important and they were negligible. But from FY22 onwards, the numbers have been bigger. 45 rupees coming in FY22 as dividends, and in FY23, the bumper numbers were there, coming at more than 100 rupees given in terms of dividend. Now, do remember the analysts have also stated that the dividend numbers might become lesser this year, but the most important thing is the company's parent company, which is Vedanta Resources. They are having almost 68% stake in the company. So they plan to actually deleverage the balance sheet, and they're expecting to pay out roughly, you could say, almost $4 billion of deleveraging over the next 3 years. So this dividend paying exercise is one of them. Now, looking ahead, of course, you must be wondering which are the highest dividend paying stocks coming in for FY23, and of course making it to the top of the list are the two companies, Hindustan Zinc and Vedanta, for FY23 with more than 20% of dividend yield coming in. But there are other companies also in this dividend theme play, and these companies include Sanofi India, REC and Oil India, where the dividend yield ranges between 8 to 13%.
Right, that's Vedanta in focus for you, the first dividend this fiscal. Also, shares of Gland Pharma plunged yesterday after a very disappointing Q4. Now, remember, this is not the first time the stock is tanked post its quarterly numbers. Moreover, Morgan Stanley sold about 0.5% stake or 9.6 lakh shares at an average price of 930 rupees per share in the stock. Let me take it across to Srishti and get in more details on the same.
Well, yes, absolutely. The stock has been disappointing its shareholders, especially for the past 6 quarters, because its earnings, we have seen a fall in this particular counter, and this time the fall has really been brutal, where in the past 2 days the stock is actually down over 32%. Remember that Gland Pharma was one stock which saw bumper listing, 14% gains on the listing day itself, and in just 10 months the stock was more than doubled. But after touching those all-time high levels, if you see the fall, that has been very brutal, 80% downtick coming in over there. Let's talk about the recent earnings, where a sheer disappointment coming in on all the parameters, although the analysts were expecting a weak set of numbers, and the factor was one of their key fungal products, which actually lost its exclusivity rights, and from 440 crores sales being recorded in FY22, that has been come down to 65 crores. So they were actually factoring in those numbers, but despite that, there were many negative surprises into the earnings, wherein they do highlight that one of their key customers has filed for a bankruptcy. So that is one big hit that the Gland Pharma is taking, because that has actually reduced the supply to that customers, which is in a financial discovery difficulty. They have lost certain other customers as well, and they also have had temporary shutdown in some of their production line, which had additional impact of 30 to 40 crores just in Q4. Other than that, the sales of their heparin, that was also low due to the lower pricing, and Gland Pharma is actually not ready to go away with their inventories, which is actually at a higher cost, and they are not ready to sell it at a lower cost and take a hit there. So this is what the analysts are highlighting, and they are also saying that the granular details seems to be very unconvincing right now. The management failed to provide any clear visibility on the stabilization ahead, and those are some of the reasons that we have seen downgrades also coming in post earnings.
Nourish, I want to bring out Kochi Shipyard, because it's like one of those halo defense stocks. And yesterday, the back of the stock was broken post numbers. Where is Kochi Shipyard headed?
So I think if you look at a little longer term chart, the stock always had a top around 400 to 430 levels. So 430 was a problem zone for the stock for the period of pre-COVID. Even after this whole rally, we saw a big breakout only happen in 2022. So now we've come down to 480, which makes it a stock which has done relatively not much in the whole space, because the stock has corrected from 680 levels to 480. So I think at 430, 450, it's actually a zone to buy. So my view is positive around that area. The stock has a tendency to correct a lot more than the rest of the shipping companies, and has been an underperformer compared to a Moscow Dock or a GRSC. But at 430, 450, that would be an opportunity to buy into the stock. the stock goes through such corrections all through the last few years. So again, expecting a slow and steady bounce back from 430, 450 all the way back to 550, 600.
Next stocks. So what a run up it's been for them. You've got price action which is very solid in Keynes, Sharma, Dixon, Amber. I mean, is this the new space? Is this the new mid cap go space for 2023? Looks like it. Look at Sharma. 280 has become 350. 1000 on Keynes has become 1300. Dixon had a puffy duffy quarter, but then it's popped right back up. 3200. In fact, it's nowhere close to its 52-week high. Amber also similar kind of a trend. It was the haloed stock, came cracking down, and from the recent low, it has popped right back up. Do you like anything in that space, technically, Nooresh?
So in that space, it's tough to take a major technical call because the data is not there. But Sirma SGS came on the radar because the stock crossed the IPO highs. So the highs made around that IPO price was around 342 in yesterday. After almost say maybe roughly 8 to 10 months, it has crossed that. That generally is an indication that the stock could see a further momentum move. So Sirma SGS would be there. Dixon is looking interesting purely for the fact that it has started making a base. The last quarter results, the stock saw a big crack. The day before that result, the stock was at around say 3,300 to 3,500. So now that is the next target, say 3,500 for the stock, and if it can sustain 3,500, that would imply the worst is over. So for now, some more legs left into this move. Closer to 3,500 as a target for the short term. And intraday fade off today closer to 3,150 should be a buy opportunity with a stop loss below 3,100.
Digant Haria joins us. Let's take a conversation forward and understand what he makes of the market right now. Digant, let's start with this theme since we're discussing it. Electronic manufacturing. I mean, what a comeback it's been. These stocks are moving as if they are the go-to stocks of 2023. The same phenomenon was at play in railways at the beginning of the year and defense last year.
Yeah, hi Nikunj. Good morning and thanks for having me here. See, I think for electronic manufacturing, the whole investment community is thinking, this is that Maruti movement of early, 90s where, when Maruti came in India with its big manufacturing setup, we really had this whole auto ancillary ecosystem which developed that, Maruti would want all their spare parts and, component providers to have factories near it. And then we saw a 20-year bull run in this sector, say until 2014-15. I think electronic manufacturing is probably at that stage. It's the third highest imported item in India after oil and gold. So it is natural that India will try to have electronic manufacturing done within their land, and yeah, that is what we are seeing. The policy initiatives are there. We saw Apple, Foxconn, Tesla. A lot of these guys who are trying to set up a manufacturing base in India. So all these stocks that you talked about, Nikunj, they are like the auto ancillaries of the electronic space. We are very early in the theme. There's surely 5, 10, 15 years of great growth. But obviously, which players really scale up, which players can really live up to the expectations of, what their OEMs want. I think that time will tell. But yes, this is absolutely the hot space to be in.
Okay, let's check with our chartists whether this is a hot space or not. But Kunal, not enough data to analyze Sirma, but what about Dixon? That's been really shooting up.
Yeah, Dixon has been performing quite well, but Aisha, I think the stock has been beaten down significantly in the last 2-3 months itself, and from its 52-week highs, the stock is a long distance away. So it has to do a lot of hard work to try and make a comeback. Even Amber Enterprises, that stock has come back towards, I think 2 months back it had come back towards a 52-week low. So that stock is also getting to a recovery phase, a long distance away from its previous major 52-week highs or 2-year highs for itself. But the other chart which looks very interesting is actually Keynes. Now, even though the data is a lot more limited, but the breakout which had happened for Keynes last week, I think if I'm not wrong, when the stock had broken past about 1,000, 1,050 levels from there, it's not looked back. It's formed a pattern of higher highs and higher lows. There was just 1 day of mild correction or a pullback for the stock after that gap up. 3-4% odd, but I think post that we've not seen any major correction for the stock. So that also indicates that now the base has shifted up higher from 950 earlier to 1100, 1120 for Keynes, and that's I think a very interesting stock to look out for.
Let's get in a view, Digant, from you morning firstly as to what the outlook is when it comes to Siemens, because the sale and transfer of their low voltage motor business to the parent company clearly seem to have spooked the streets, and analysts have attributed various factors. Valuations are lower, minority shareholders may not approve the deal. It's at a time when the domestic market is showing you tailwinds for LV Motors. What's your outlook, and why do you think the street was so displeased?
See, I think street is, see the stock, we all know it's pretty expensive. Maybe, 60 times earnings or even more, is what it trades at. So any small disappointment and, the stock gets hammered, it's quite natural. But see, Siemens has a history of doing this that see, most of the MNCs in India have to respond to what their global parents want to do. They really don't have a choice. And Siemens, we have seen that in 2013, multiple times they have sold or bought some things. Now fair valuation is always a question because India is a very expensive market for these stocks. But see, I think that the motor business of Siemens, Siemens was the third largest motor manufacturer in India after CG Power and ABB. Now, Siemens had actually outsourced a lot of its manufacturing, and what we hear from the market is, a lot of their vendors are themselves copying the Siemens technology and selling it as, ये Siemens का product है, तो आप हमसे सस्ते में ले लो. So I think Siemens had really lost the game in terms of the motors market, as you rightly mentioned, Anand, that motor market is doing well because of this whole Make in India energy efficiency theme. I think it's a market which will do well. But it's fine. I think Siemens getting out of this business is fine because they'd anyways lost focus long back. Evaluations we can debate. We'll probably have these whole discussions for a few weeks, and then once they win some more railway orders or some more automation orders or power sector orders, I think people will forget this and move on. So I would just think that this is an event which we should look beyond.
Right. PB Fintech, the losses have narrowed, hopeful of turning pat in the next few quarters. This is the same kind of commentary that we heard even from Zomato. Digant, time to buy into these new age tech companies already?
See, I think, I would say the negativity around them is gone. But they're all showing profits. And, like a year back, we all wanted to see growth, right? We valued them at, 15, 20 times sales because they were going to grow and they were going to, grow at say 25, 30% CAGR for 10 years. We are already seeing that, that growth is getting punctured because they have started focusing on profitability. So I just think that, these stocks are far more reasonable than in the past. But we are still, a little away from, just going out and saying that, hey, these valuations are fine. You should go ahead and buy and you will make big returns. I don't think we are at that stage for any of these fintechs, be it PB Fintech, be it Paytm, be it Zomato, be it Nykaa. We are nowhere there. But yeah, I just think that, a buyer today is not looking at a 50% downside at least. So that's the solace if, you have to find one.
Well, on a sequential basis, the revenues have come in higher actually at about 869 crore rupees versus a comparable of 610. And the loss has narrowed down in how it's less than 9.5 crore rupees as compared to 87.6 crores that they actually posted in just the previous quarter. Kunal, you've been quite gung-ho and bullish about PB Fintech, right?
Well, yes, Harsha, I would continue to be extremely bullish on the stock price. I think, what we've seen in the last 3 months, specifically from the first week of February, a breakout for PB Fintech above, I think, 450 mark. And from there, it's just not looked back. We've seen, initially 3-4 weeks of consistent price uptrend, almost like a V-shaped recovery, strong price volume breakout. So those ingredients which we typically look out for a turnaround in stocks and which have been beaten down significantly over the last 12 months prior, I think all of those ingredients were set in place for the stock. It's made a multi-month high, I think last month or so in the month of April, now consolidating above that 600 levels. But again, the pace of rally has not ebbed off for the stock price. Now, because the initial levels were closer to 400, 450, that has now jumped up to 600, 650 for PB Fintech. So it's trying to consolidate at higher levels, but the momentum is still intact for the stock price. I would be extremely bullish on the stock price and would be surprised even the stock hits about that 700 levels in the next couple of sessions.
All right, there you have it. That's the view coming in on PB Fintech. But let's get a move on then. Some top fundamental stock ideas. What is it that Sandeep Sabharwal is betting on within the defense space? Listen in.
huge, long gestation period of most of their projects. So most of the analysts get excited when the order is announced, but they don't realize that designing process itself will take so long. The execution might start after 3 years and deliveries might be after 5 years for many of these projects which companies like these shipyards are doing, or also a company like Hindustan Aeronautics, etc., are doing. So I think investors need to keep that in mind before buying their stocks, not immediately extrapolate orders uh, into profit projection. And longer term outlook for most of them still seems to be good, but then many of the stocks have run up so much that they seem to be priced for perfection. Among the best listed companies, I think Bharat Electronics came up with decent results. So I think that's something which we have also accumulated, and I would be positively inclined towards that because that's where there's some valuation comfort. In terms of the sheer positivity of growth outlook, Hindustan Aeronautics stands out because of the magnitude of orders they've been giving. So that's something one can accumulate on every dip.
Okay, that's the view coming in on the entire defense pack. Let's take stock of what IT as well have been up to. And, you know, we've been highlighting as to how IT, the sector, has been a gainer for the last 3 consecutive trading sessions, while Infosys continues to be a year-to-date loser. That's not quite the case with some of the mid-cap IT names. What with the move on a Coforge and an LTI Mindtree, they've all been scaling up very, very nicely. Digant, worst behind IT, you think?
See, not so sure that worst is behind because, see, the worst or the best for IT depends on, what happens to US and Europe. And then I think, we are seeing some bit of stability there after the big down move of last year. But that does not really mean that, the bear market in the US especially is over. I just think that, we will see one more down leg there. And most of these IT stocks will respond to what happens to the US markets. So I think that's a very broad view that the worst is not yet over. But then within the sector, I think there is a case for separating some of those the large companies which are really dependent on the US macros, and some of the smaller ones, say like a Cyient or Zensar, where there is an standalone turnaround happening in their own individual businesses. So I think yes, IT broad view is where the worst is not over, but that does not mean that there are no pockets of opportunity there. But it's become more stock specific in IT rather than the sector as a basket.
Digant, just stay with us. We've got a very interesting conversation coming up with Som Distilleries regarding the expansion that they are planning, and it seems that a strategic tie-up with Carlsberg India is in the works. We have with us J.K. Arora, the MD at Som Distilleries, joining in on the show right now. Mr. Arora, morning. Great to have you on ET now. Tell us all about this Carlsberg deal and what synergies are you expecting for the Odisha plant, especially when it comes to the utilization of capacities?
Yeah, this is quite a good development for the company. The Odisha, out of all 3 plants, Odisha plant, we were a bit apprehensive in the beginning that so much of capacity expansion when exactly we would be able to utilize. But after this tie-up, from the day one, we are completing the expansion work by 30th May, and from 1st June we are starting the production for Carlsberg India. So it is quite a good development for company, and the capacity utilization will be 30% more. So the overall overheads of the company will go down and the profitability will boost definitely.
Raise additional funds for this capacity expansion?
Funds has not been an issue with the company. Funds has been this year. It's quite a good year for the company. We have doubled the sale in Karnataka. We have almost 50% more sales in Madhya Pradesh, Jharkhand, UP, Delhi. They are doing, all markets are doing quite good. So funds has not been an issue with the company, and there is not much fund involved as well, because it is the co-packing arrangement where all the raw material, packing materials, Carlsberg India is providing. We have to only provide them the plant for their production and sales setup.
Interesting. The last time we spoke, you were talking about how you plan to scale up your India market share to 15%. Currently, it's at 9%. Just wanted to understand what's the market share you think you could garner with now Carlsberg coming on board.
Yeah, these are the all steps towards the to the betterment of the company. If you see the markets where we are operating, we are like UP. We are having almost more than 200%, 250% sales more than the last year. Delhi, we have more than 100% sales over the last year. Madhya Pradesh, where we are already number one, where the even 1% market share is a big thing. Here we are having about 14% plus over the last year, which is quite a substantial for the company, because the highest profitability comes from Madhya Pradesh. So it is overall market share is increasing. This thing by the end of the first quarter, you will find that company has done quite well all over India.
Appreciate your time, sir. Thank you so much for joining in and giving us the latest updates there on Som Distilleries. That stock as well yesterday was a buzz. But lots of stocks that will be a buzz today on the editor's radar, and that's what we're here to discuss. We've handpicked two of them, and let's begin then by talking about MCX. That stock has been under pressure of late, and yesterday's session too, 19% Nikunj from a year-to-date peak, and perhaps the biggest concern is the fact that there's been the delayed transition to the TCS software.
This is one company which has frankly surprised me. I mean, I was expecting a lot in terms of delivery from MCX. It's almost like a monopoly. What 85% plus market share of the four most traded commodities in India: gold, copper, crude. They have a lot of market share. But why is that they're not able to get their IT business right? The management is confident that they will be able to fix it. The dry run has started. They are looking at a migration from TCS, and 97 to 98% accuracy is there. But in an exchange, you need 100% accuracy. That 2% really matters, right? So they have to get that 2% right. The management feels that it's going to be in this quarter. However, brokerages feel that are of the view that it will take at least 3 more quarters. Okay. Even if it takes 3 more quarters, I think the stock, looking at the revenue, the moat around it, the fact that markets know that the delay has already started, I think there's a lot of margin of safety. Until and unless the entire software transition goes beyond FY24, I think MCS could be set for a strong comeback in the second half of this year, because the business is growing and the timeline now, I think, is very well defined.
Software transition, that is critical when it comes to MCX. Moving right on then, Max Healthcare is the next newsmaker that we're discussing. GQG Partners buying shares in the company. Price point at 550, and Nikunj, we all know GQG Partners, of course, made their mark in the Indian markets with the purchase of Adani shares.
Well, they've known for buying Sun Pharma at a turning point. They've known for buying ITC when things were not looking great for ITC. They're buying into Max Healthcare. Now, Max Healthcare is interesting because large part is owned by Axis now. There is a pledge share issue, which I think is also getting sorted by the previous owner. B, the insurance business per se has not really been a massive outperformer. And within the private insurance space, I guess now there is, within the life insurance space, LIC is really stuck in a rut, so to speak. So there are a lot of factors which I think are at play for Max, Healthcare. You've got insurance, that Axis Bank ownership, Bancam tie-up, big investors kicking in, and cheap valuations. Now, these are some of the classic holdings of GQG. The reason why I'm bringing it out is because whatever they've bought, they've been very contra. ITC, State Bank of India, Bajaj Finserv, Coal India, NTPC. So it's not HDFC Bank here. It is no ITC here, no Infosys here. They like to buy fear, like they bought into Adani. And I think that same factor is at play when it comes to Max Financials.
Okay, so we'll have to watch out for Max Health as well in trade, and Aisha, find out which are some of the other stocks as well that are catching our experts' eye.
Oh, yeah, absolutely. MCX, Max Healthcare, both on the radar. But let's just look at the recovery yesterday. While, of course, it was IT which sectorally led that recovery, it was the Adani Group of names as well which held out very, very smartly. Be it Adani Ports, Adani Enterprises, the entire cluster did extremely well. You know, we were marking the kind of recovery that most of these names are seeing and what's actually leading to that. Remember, the Adani Group has added more than 90,000 crore rupees. That's roughly about $10 billion over the last 2 trading sessions. You heard me right. $10 billion in just 2 trading sessions. Of course, it's a very large group with many listed entities out there, but it has seen the biggest increase since Hindenburg's report, which came out in January. So Adani Enterprises, Ports, the market capitalization addition has been anywhere between about 15 to 24,000 crores in just last 2 trades. Digant, I don't know if you track these stocks carefully or would recommend buying into this, but definitely a big overhang gets lifted, right, after last Friday's announcement of the Supreme Court giving a clean sheet.
See, I think all those legalities and I would leave that aside. What Adani, what we really look at is are they able to service their debt? Are they not expanding at the pace at which they did in the past? I think both the answers are there. That see, one, they've really stopped expansion. We've heard of no new order wins, no new land purchases or project new project entries by Adani. Which is the right thing to do. Second is they had a lot of international debt, and after an event like Hindenburg, they should focus just on ensuring that those debt holders do not pull the plug, because that's the lifeline for any group which is involved in infrastructure creation. So I think they are focusing well. They did one round of deleveraging by selling shares to GQG. I think they are trying for a second round of share sale, where they'll again repay some 15-20,000 crores. I think if that second round of share sale goes through, I think the overhang for this group, in terms of the banking sector exposure and the group not being able to service debt, I think a lot of those things would be over, because then the next large repayments happen towards the end of 2024, which is reasonably 18-20 months away. So from that angle, I think what Adani is trying to do, it's the right thing to do. But yeah, we're not tracking the individual stocks from an investment standpoint.
Where will these stocks settle? I mean, it was an absolute frenzy, let's say, in the month of same time last year. They were expensive also, frankly, if you look at the traditional benchmark like price to book or even P multiple. When you look at the valuations in Jan. Post that, these stocks got hammered out of shape and now they've recovered. Where do you think these stocks eventually will settle?
I think, see, Nikunj, we've all seen during, ILFS and, the NPA crisis of 2016 to 18 that until there is that overhang, you cannot really call out levels because, not every business of Adani has hard assets, cash flow throwing assets. A lot of them will throw cash flows somewhere in the future. But today there are only these, 3 companies which throw, like real large cash flows, which is the Ambuja Cement and ACC together. And, there's this Adani Ports. And lastly, there's Adani Enterprise, which has the Mumbai airport also. So I think it's very difficult, Nikunj, to really value because, when the perception goes for a toss, like one event, like not able to roll over some debt will again, start the scare in the stock. So I think, whenever such debt related events happen, we have to just look at debt and not look at the stock price. At least that is what I learned during the ILFS crisis and the NPA crisis of 16 to 19.
Well, I want to point out Muthoot Finance, Nourish. Big price action, breakout stock, closed above the 200 DMA.
So this is a tough one. The sector has been in a pain for quite some time. Muthoot Finance again is back to the same price where it has seen a flip-flop from. So 1150 is a major problem for the stock for the last almost a year or so. Manappuram continues to be in the dumps. So out here, yesterday I would still take it as a one-day move. Wait for some more time, let it sustain about 1150 and then maybe accept that the trend has changed. So for now, 1150 is a major problem. That used to be the support in 2021 to 2022, now is acting as a resistance. So yesterday was a one-day move, but if it can sustain about 1150, that would change the tracks and as well as trend for the stock. So for now, would wait and watch, see if this is another one-day action or not.
Digant, any reason why suddenly hospital stocks are just doing cartwheels? It's not just restricted to an Apollo, Narayana Healthcare, about 900 rupees. You got good comeback even in a Shalby. Fortis happens to be a special situation stock, but apart from that, this entire space is just full of excitement.
Yeah, I think Nikunj, a lot of fund managers, investors have started equating this sector with, what we call as the rich man's consumption sector. Because, in COVID, a lot of those tourism, the medical tourism did not happen. A lot of people postponed their surgeries and, whatever procedures they needed. I think a lot of that is bouncing back. We can see some of that in the results as well. And nobody is announcing new capex because everybody has good capacities and those capacities are getting utilized. So I think people are now thinking that okay, this was a capex heavy sector before COVID and we would not treat it like a consumer company, but this is one phase of the market where people are willing to treat it as a consumer company. And I somehow feel that the days of past definitely are over, that where this capex heavy and non-free cash flow generation, those days are over. I think we'll see strong cash flow generation in these hospitals over next 18-24 months, and which is why markets are rewarding it the way they are. Markets really like when companies go from say a negative cash flow to a large operating, large positive cash flow. That is what we are seeing in most of these hospital stocks.
Apollo Hospitals 4605. Let's take the clock back of Apollo Hospitals to COVID actually. And from COVID, just, these stocks have just expanded. Look at that. And there you go. Now this is 2023, my dear. Let's go back to 2020 or 2021. It was at 1600, I think, if my memory serves me right, just before COVID. And from there, the stock has just gone, absolutely, haywire. So Digant, which is your favorite rich man consumption story? Or let me ask you, what are you consuming? So then I'll get a sense that a rich man like you, what he's consuming, maybe our viewers will get a sense.
Okay, I'll rich is a very relative term, but I'll still take that question and I'll say that real estate is something which I would like to categorize in a rich man's consumption, and it's something which is still reasonable. I would, we would all love to have titans and trends and jockeys of the world in our portfolios, but obviously the valuations are so rich that at best what we get there is compounding. So I think there are two pockets where we still think there is some value left, and which is actually a rich man's consumption theme. So one is the real estate. We just think that we've seen the highest home loan rates for the decade already. Home loan rates will not cross 9.5%. So that really augurs well for the real estate cycle. The cycle had anyways turned after COVID. It had paused because of these interest rate hikes on the home loan. So I think real estate is something we're really bullish on. Companies like Godrej, Shobha, DLF, Brigades of the South. So that is one. We were all wanting bigger houses after COVID. We all realized that okay, we cannot tolerate each other as much as we thought, and we're all wanting to move to bigger houses. So that theme will stay for the decade. And second, what we like is the travel and tourism theme. We can just see it in our own behavior of our friends, family, everyone around. I think that boom is here to stay. So selecting the right, either hotel stocks or luggage stocks, or in fact, even there's just one aviation stock which is worthy of consideration. I think a lot of these, stocks have a good, probably have a good 4-5 years ahead of them. So yeah, travel and tourism is one, and second, real estate. These are the two rich man consumption themes we like.
2 minutes to go, and then we'll get the first pre-open rates. I have to go back to Zomato. Dipinder Goyal these days is really tweeting. He tweeted about how the Zomato food delivery, on the Mother's Day, the Zomato food delivery numbers were as high as what they delivered on the New Year Eve. Yesterday, there's a tweet from Zomato that 70% plus of the total food delivery which was done in cash, actually everybody paid in a 2,000 rupee note. So yeah, interesting. We've discussed This one, Nooresh, time and again, Zomato, but it is so liquid that for a trader, every 1 rupee here matters. Technically, where is the stock headed? Nooresh?
So the view remains the same technically, that the longer term trend has finally bottomed out. And if you look at the price action, the initial move from 57 to 67 took place. And now we are consolidating. Yesterday also 67 acted as a resistance, and now 57 should continue to remain the support. If you look at a little longer term chart over the last 1 year, there were flips towards that 70-75 mark. So that is the target, which is where closer to 75 in the short term. And once we cross 75, that is where it should get into a momentum phase where people start believing. So overall, the base is setting up here. Till the time it holds above 55, 57, it's a buy. In the short term, I would be watching out for a momentum trade when it crosses 67. For now, it is still in consolidation mode between 57 to 67. Little shorter term, that would be 61 to 67. But once we cross 67, that would be a trade quickly for 75. So for now, you want to be either buying around 57 or either on 67.
Okay, meantime, you also have Vedanta in the spotlight, and that company, as we said, they declared their first dividend for the new fiscal year. Digant, just wanted to know your take as to what you believe this means in terms of the impact as well on their debt reduction plans and the kind of volatility that we've seen in Vedanta.
Not really tracking this company closely, so I would really not be able to comment on.
Skip Vedanta then and get in a view instead on the pharma space. Citi has come out with their latest note on Sun Pharma. They've got a target price of 12.25, saying that a lot of the margin concerns are overdone. Where within pharma are you finding comfort, Digant?
So, I think Nikunj just asked me a question on hospitals. So, see, pharma has multiple legs, So, one part of pharma is, which has sort of consumer kind of characteristics, and the second kind of pharma is, which have commodity kind of characteristics. So, Sun Pharma is a mix of both. But I just think that, the pharma space, the sector itself is undergoing through a massive, price correction because, there's capacity expansion happened all over the, pharma suppliers and all. I think we would really stay away. We're not finding too many bright spots, apart from, say, hospitals, which is more like a rich man's consumption play. And then, somewhat, these OTC companies which sell branded formulations inside the country, something like an Alchem or, these are the ones that we places where we are looking at, but not really anything meaningful in the pharma space. We think that 6-12 months, it's still not a good time for pharma.
Right. Okay. Digant, great to have you on the show. Thanks as always for taking the time out. Let's just revisit where the SGX Nifty and the pre-open rates are settling in at. 18,357. I think a couple of these stocks to look out for. There's, of course, going to be PB Fintech. That's going to be top on our radar, along with BPCL and Vedanta as well. But let me welcome on board Atul Kumar Goyal, the MD and CEO at PNB, and find out how their quarterly performance was. Atul, you've guided for a 12 to 13% growth. You grew well in agri as well as MSME. Where will growth come for you? And tell us about what traction you're seeing in corporate growth.
This 12 to 13% growth will come from the RAM sector, because RAM means retail, agriculture, MSME, which is our focus area. In addition to that, the corporate, there is also demand from the corporate side. Some of the corporates who are sanctioned the working capital limit, earlier they were not availing, last year also and the current year also, they have started utilization also. And in the some of the corporate, they have also made a request for the capex. I mean, for the enhancement their existing capacity. Some of the steel companies, some of the cement company, they are approaching us, and there is a very good demand from the NBFC sector also. But retail will be our main focus area. Retail may be particularly, we will give the focus on the housing loan as well as the gold loan.
Planning or preparing to implement the ECL based provisioning. Talk to us about your preparedness and for PNB in terms of numbers.
As far as PNB concerned, first you see our provision coverage ratio, which was around 81% in the last year, March 22, which has improved to 86.90%. This is giving the comfort to us. The another thing, this is the draft guidelines. Final guidelines is about to come. We should wait for the final guidelines. And moreover, in the draft guidelines, RBI has permitted whatever will be the requirement of the provision, they will give the 5 years. The one more important thing, because as on date, it is on the basis of the incurred credit loss. Means if account has become NPA, then you have to make the provision. And in the ECL framework, it will be based on the expected credit loss, which will be based on the PD, which will be based on the LGD. And one more thing I will give the comfort to all. We are every month watching the few new underwriting, because we have taken a lot of steps to improvement in the underwriting as well as the collection efficiency. In the last, from the 1st of the July 2020 to 31st March 23, around 5.72 lakh crore we have sanctioned, out of which 5.18 lakhs crore has been disbursement, and outstanding is around 4.16 lakh crore, where the NPA amount is only 1,178 crore rupees, which is coming only 0.23% of our new underwriting books. So this is giving the comfort. As far as your question is concerned, when the guidelines will come from the RBI, we are fully prepared to implement it.
So would you think it would be fair to say that there will be no impact or no major dent on profitability and ROAs then?
I think there will not be any meaningful dent, but what I told you, we should wait for the final guidelines to come from the RBI. Because then there will be a clarity also, because as on date, the method of the computation of the PD and LGD may be the different in the different bank. When the guidelines will come, that will be very appropriate for all the bank, how to calculate this provision for the ECL.
Right. You've also guided for a credit cost of 1.5 to 1.75%. What gives you the confidence of being able to manage credit costs at this range?
There is 2-3 factors for this. Point number one, the recovery in the last year was very robust. 29,000 crore recovery we have made against the target of the 32,000 crore. And the every quarter from the June 2020 to the last March 2023, every quarter recovery was more than the addition. And our PCR has increased from the 81 to 86.90%. So our aging provision requirement has reduced. And since the recovery is much more than the addition, for the current financial year, we have set a target. Our recovery should be the double from the addition. So this is the reason we have given the guidance as against the 2.03% the last year. It should be range between 1.5 to 1.75, and we are confident to maintain this.
All right, appreciate your time. Thank you so much for joining in, Mr. Goel, and sharing with us the outlook on your financials as well as for the bank. Let's move on then and put the spotlight on some exclusive news. One of the best performing stocks in the MFI space in the past few weeks, Spandana Spurti, could actually see a big block deal or a series of block deals in the next few months as per sources. Let's take it across then to Ajay Sharma, who joins in with all those exclusive details. Ajay, what are you picking up?
Well, that's correct. We are picking up from our sources that there could be start of a couple of very large block deals which could happen in Spandana Spurti. And this is actually the former MD of Spandana Spurti, Padmaja Reddy, is considering selling her residual stake via block deals. Well, the institutional interest is very high in this stock. So they are asking for one single block. But what we understand from our sources that Padmaja Reddy may be considering selling it in multiple blocks of 2 to 3 blocks, because they have almost 14.5% stake residual in Spandana Spurti. You remember, Spandana Spurti is actually Kedara backed, and Kedara Capital is the largest shareholder there. There was a change of guard, the change of management when the founder and former MD's term ended, and there was a new management had taken over the leadership position. The former MD Padmaja Reddy still have 14.5% in the company, though she doesn't, is not in the executive capacity in the company anymore. She is right now busy building her own company, a new company, Kirtana Financials, and this proceeds of this block deals will be going to fund the progress of that particular NBFC, which is a women-centric NBFC she's setting up. This 14.5% stake in Spandana is valued at close to 700 crore. And we understand that via sources that ICICI Securities has been appointed as the banker to look for prospective investors. If you look at the last Q4 results, the company has really turned around very smartly, and very good strong set of numbers came in. So there is a lot of interest by funds, but funds are asking for a single block. And what we understand that because Padma Reddy though is interested in funding her own venture now via this money, is not, there's no fire exit over there. So the likelihood of very deep discount is not there. That's what we are gathering. So we spoke to the management, the current management. They refused to comment. They said we don't comment on market speculation. We even sent out mails and messages to Padunja Reddy regarding this, which did not get any response. But we know that there's this block which is there in the market, seeing good response, but most of the players want one full block. Padunja Reddy may actually go ahead and sell it in tranches without any deep discount. So watch out for Spandana Spurti on this news of ours.
All right, thanks very much, Ajay. We'll certainly be watching out for Spandana Spurti, big funds eyeing stake in the company, as Ajay just highlighted. But